Welcome to Iron Financial. This is the place where we forge stronger portfolios by putting market narratives under extreme stress. And today, we are putting York Space Systems, ticker YSS, directly under the hammer. Now look, this is a company that's positioned itself as a critical prime contractor in what everyone is calling the new space race. They're built from the ground up to deliver entire satellite constellations, and they're doing it with incredible speed and scale for some very serious clients, like the Pentagon. But here's the thing. They just had their IPO, and the question for every single investor staring to this stock is brutally simple. Is this company built on a solid foundation for real, sustainable growth, or is this whole thing just a beautiful facade built on pure hype? Okay, let's get into it.
And the bull case for York kicks off with this incredibly powerful, almost audacious claim from their CEO, Dirk Wallinger. Now listen to what he's saying. He's not just telling the market they had a good year. He is flat out declaring that his company is fundamentally rewriting the entire playbook for the whole aerospace and defense industry. This isn't your standard, run-of-the-mill corporate fluff you hear on earnings calls. No, this is a declaration of war. It's a statement of intent. They genuinely see themselves as the new blueprint for execution, and you better believe this claim forms the very bedrock of the entire bull argument we're about to build.
Whoa, hold on a second. Before we all get swept away by these grand mission statements and bold declarations, we have to do what we do here at Iron Financial. We run the numbers. Forget the hype, let's look at the cold, hard facts. So here's our plan, our agenda for today. We're going to start by running the company through the earnings gauntlet. Then we'll construct the bull case and immediately follow that by trying to break it with the bear case stress test. After that, we're going to look at their foundation for the future with the 2026 Outlook and see what Wall Street analysts think. And only then, after all that, will we deliver our final iron verdict. Let's get to work.
Right, let's start the test. Section 1. The earnings gauntlet. Look, every single investment thesis, no matter how compelling it sounds, must first survive contact with the raw numbers. There's no escaping it. So we're starting right there, laying out the big top-line results for both the full year and the crucial fourth quarter of 2025. You can think of this as the first impact test. Let's see how well this structure actually holds up under initial pressure. Okay, so on the left you see the heavyweight punch of the bull case. Full year 2025 revenue came in at an impressive $386.2 million. And get this, that is a massive 52% year-over-year increase. Let me be clear, in an industry dominated by slow-moving, established titans, that kind of growth is absolutely explosive. It's what separates the true leaders from the laggards. But, and you knew there was a but coming, and it is a big one, the right side of this slide tells a very different story. In the fourth quarter, the final stretch of the year, they missed Wall Street estimates. The Street expected over $109 million, and York delivered $105.3. Now, you might think that's a small miss, but in the world of high-growth stocks priced for perfection, it's a crack in the armor. And it immediately forces us to ask the big question. Is this incredible growth engine starting to sputter? Is it sustainable?
And that question right there is the perfect pivot into building the full bull case. We've seen the headline numbers, the good and the bad. Now it's time to get under the hood and really inspect the engine that's driving this company forward. We're going to forge this argument for growth piece by powerful piece and show you exactly why that incredible 52% full-year number wasn't some fluke and why the bulls believe it's the new standard for York. Let's just hammer this first point home. 52%. I want that number to sink in. This is the primary pillar of the entire bull thesis. You simply do not achieve this kind of top-line growth by accident or by luck. This comes from one thing, winning massive, game-changing contracts, like the ones they secured for the Space Development Agency's proliferated warfighter space architecture, and then, and this is the crucial part, actually executing on them. This isn't just growth for growth's sake. This is a direct reflection of them ripping market share away from the old guard and cementing themselves as an absolutely indispensable prime contractor for the U.S. government. But look, revenue is only half the picture. Any company can chase revenue. What's truly structural, what's really fascinating about this slide is the insane operational leverage it demonstrates. Their gross profit for the full year didn't just grow, it absolutely exploded, up 133%. Now, what this means in simple terms is that for every new dollar of revenue that comes in the door, a much larger portion of it is falling down to the gross profit line. They are becoming more efficient as they get bigger. They're getting a handle on what are called negative estimate at completion, or EAC adjustments, which are basically cost overruns on these big fixed price contracts. This proves the business model isn't just scaling, it is strengthening, it is hardening as it scales. Now let's put this all together on one comprehensive slide, because this is where the story really comes into focus. Just guide your eye down the table. Revenue, as we said, up a massive 52%. Gross profit, even better, up a staggering 133%. But now let's look at the bottom lines, where the bears love to live. Yes, they are still losing money, a net loss of $84.5 million, but look closer. That's a 15% improvement over the nearly $99 million they lost back in 2024. And now focus on adjusted EBITDA, which is a great measure of core operational performance. It went from a loss of $43 million down to a loss of just $8.3 million. That's an incredible 81% improvement. The trajectory here is undeniable. This is not a company that's spiraling out of control. This is a company that is rapidly marching towards profitability.
And this incredible financial progress isn't just happening on a spreadsheet. It's being forged in the real world through elite operational execution. Let's break this down. On the program side, they delivered 21 crucial Tranche 1 satellites for the military and launched their Dragoon mission 75% faster than a typical government program. Think about that. On the corporate strategy front, they are making incredibly smart vertical acquisitions. They bought Atlas for ground station communications and Orbidian for satellite propulsion. They're not just buying companies, they're buying control of their supply chain. And on the technology side, they're demonstrating next-gen capabilities like Link 16 from space, which is then translating into huge commercial wins, like a brand new $187 million contract. This isn't a company selling a PowerPoint presentation. It's a prime contractor delivering real, tangible capability. Okay, that is a very shiny, very impressive structure you've just built. I'll give you that. But every single structure, no matter how impressive it looks on the outside, needs a proper stress test. You have to actively look for the hidden weaknesses, for those tiny hairline fractures that might not look like much now, but could become catastrophic failures when real pressure is applied. So now, it's my turn. It is time to apply that pressure. Welcome to the bear case stress test.
And we are going to start by going right back to that crack we found in the first 5 minutes, that fourth quarter revenue miss. You see, the entire bull case is built on this grand narrative of flawless execution and unstoppable explosive growth. But these numbers, well, they don't lie. And when your stock is priced for absolute perfection, any imperfection, no matter how small, matters a great deal. So is this just a one-time slip-up? Maybe it was due to a supplier delay, like they said. Or is it the first real sign that the incredibly complex logistics of building dozens of satellites all at once are finally starting to cause some serious strain? This is the first red flag, and we can't ignore it. And believe me, the red flags get a whole lot bigger and a whole lot brighter when you move from the income statement over to the balance sheet. These key financial health metrics, taken from sources like Guru Focus and Simply Wall Street, they paint a genuinely concerning picture. A net margin of negative 33%, an operating margin of negative 22%. I mean, those are just massive holes in the financial bucket. But the real alarm bells for me, the ones that are screaming danger, are the liquidity ratios. A current ratio of 0.8, let me translate that for you. That means for every single dollar of short-term debt that's due, the company only has 80 cents in short-term assets to cover it. That is below the critical 1.0 threshold that signals financial stability. And the cash ratio, it's even worse, at a tiny 0.12. These are not minor issues. They raise serious questions about the fundamental financial integrity of this company. So the crucial question is this, and I'm going to pose it directly to everyone watching. With a current ratio this far below 1.0, is York burning through its cash pile way too quickly to sustain its own operations? Now, I know what you're thinking. The IPO brought in over $580 million in net proceeds, and yes, that absolutely bolsters the balance sheet. But that money isn't infinite, and what it's really doing is masking the ugly truth that the underlying business operations are still consuming cash at an incredibly high rate. So how long can you sustain this kind of burn before you have to go right back to the market, cap in hand, asking for more capital, and potentially diluting the very shareholders you just brought on board? That is classic rearview mirror analysis. You're focusing on where the car has been, not where it's going. The IPO fundamentally changed the entire game, making those year-end liquidity metrics you're so concerned about effectively outdated. The real story isn't the cash they burned to get to this point, it's the financial fortress they are now building with that new capital. So let's stop looking in the past and look forward, at the 2026 Outlook. This is where the real forward-looking case is forged. This right here is the blueprint for future growth. Management has gone on the record and guided for 2026 revenue to be between $545 and $595 million. Now let's just take the midpoint of that range, call it $570 million. When you compare that to 2025's $386 million, that's roughly 48% year-over-year growth. This is a powerful, unambiguous signal to the market that the 52% growth we just witnessed was not a fluke. They are telling us it's the baseline. They are projecting another year of massive, sustained, and powerful expansion. And here's the reason why that guidance carries so much weight, so much authority. This isn't just some hopeful forecast scribbled on a napkin. No, this is a construction plan based on materials that are already on the job site. Just look at this chart. Over 70% of their entire 2026 guided revenue is expected to come from their existing backlog. These are signed, sealed, and delivered contracts. They're locked in. All they need to do is go out and win a relatively small amount of new business to cover that remaining 30%. This dramatically de-risks their guidance and gives them an incredibly high degree of confidence in hitting their numbers. It's not a guess, it's a plan. And this number right here brilliantly illustrates the sheer scale of that backlog. They ended the year 2025 with $543 million in secured future work already on the books. This is a fortress of future revenue. It insulates them from the short-term turbulence of the market, from the whims of government budgetary cycles. While other, weaker companies are out there frantically hunting for their next meal, York has a pantry that is fully stocked for the next year and well beyond. This provides the kind of long-term visibility that serious, long-term investors absolutely crave.
A massive backlog is great. I won't deny that. But it's still largely based on the company's own projections and promises. So the real question is, what do the outside experts think? The people paid to scrutinize these numbers for a living. Let's take a cross-section of Wall Street analyst estimates. Let's find out if the professional consensus aligns with this incredibly bullish blueprint, or if they see the same dangerous cracks in the foundation that I do. Well, the analyst consensus is not just positive, it's overwhelmingly positive. I mean, this chart could not be any clearer. Wall Street is forecasting an annual earnings growth rate for York of nearly 94%. Now, just compare that to the broader aerospace and defense industry, which is chugging along at 17%, and the entire U.S. market at under 16%. This isn't just simple outperformance. This is a complete detachment from the peer group. Analysts are clearly pricing this company not as a legacy incumbent, but as a genuine hyper-growth disruptor, poised to completely upend the industry. Okay. The growth forecasts are impressive. I will concede that point. And yes, the consensus is that they will finally hit profitability within the next 3 years. But that timeline is the entire debate, isn't it? 3 years is an eternity in capital markets. How much more cash are they going to burn through to get there? Will those deeply negative margins improve fast enough to satisfy the market? The market is forward-looking, sure, but it's also incredibly impatient. The real question is whether investors will have the stomach, the patience, to wait for that profitability, especially if there are any more cracks, any more of those little quarterly misses along the way.
Which brings us to the end of our analysis. We have run the numbers through the gauntlet. We have meticulously built the bull case, and we have run the bear case stress test against it. We've looked at the foundation they're laying for the future, and we've cross-referenced all of it with the experts on Wall Street. Now, it is time to weigh all of the evidence and deliver the iron verdict.
So the bull case, it's forged from pure, unadulterated strength. You have explosive 52% revenue growth and an even more impressive 133% jump in gross profit. It is a story of elite operational excellence, of building a fortress-like backlog of over $500 million that gives them incredible visibility into the future. But that stress test we ran reveals some very real fractures. That Q4 revenue miss, no matter how small you think it is, raises legitimate questions about their ability to execute under pressure. And the balance sheet clearly shows the strain of all that rapid growth, with a deeply concerning 0.8 current ratio that signals a dangerously high cash burn rate. The path to profitability is visible, yes, but it is a long and potentially treacherous road. And that brings us to the absolute core of the issue. This is it. This is the central question that every single investor looking at YSS has to answer for themselves. Do you believe that the spectacular, undeniable growth trajectory is powerful enough to overcome the significant and equally undeniable balance sheet risks? Are you investing in that 94% forecast earnings growth, or are you deterred by the 0.8 current ratio? This is the trade-off. There is no easy answer here. So we leave you with this final, critical question. Is York Space Systems a truly forged asset with the structural integrity and the tensile strength to become a dominant force in this new space economy? Or is it a beautiful financial facade, a compelling growth story that's hiding fundamental weaknesses that could cause the entire structure to crumble under its own weight? The numbers are on the table. The arguments have been made. The verdict is yours to forge. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.